Cool. Here we go. Welcome everyone live, and of course, those of you watching on the recording, just one quick housekeeping item. We are still hosting these sessions, and this one in particular, the Mailbox Money Masterclass, will continue to happen on the second Monday of every month at 10 a.m. Pacific time, 1 p.m. Eastern time. If that will ever change or ever cancel for any reason, I will let everybody know ahead of time. So, that being said, let's dig right in. So, as always, I have a little bit of content planned in terms of training, but this is also a great time, being that we're on a once per month rhythm now for this particular session. If you have any questions about anything related to mailbox money, this is a great time to ask those. Jerry, I know you had a few questions about Shield protocol and launch dates and what's some upcoming training for that. So we'll, in due time, all of that will kind of come together. But if anyone else has any other questions as we go, you can drop those in the chat. I always give some space at the end where I shut up for a little bit. Everyone's welcome to kind of throw themselves off mute and chime in. So I thought what would be helpful and especially relevant, given the market conditions the last few weeks, would be to talk a little bit about, hey, what happens when there's dips? What happens when the market retraces a little bit, as it always does, and as it always will forever into infinity? And I don't mean like a full-on bear market. That's a different issue. Bear market where there's just like this general downtrend for more than 12 months. I'm talking about just what we've experienced in the last few weeks where things are not always up and to the right forever and things pull back a little bit. And one of the reasons I think this is especially relevant is because I've been having conversations behind the scenes with a lot of people, especially in the mastermind, one-on-one with folks, where they're a little bit thrown off, right? It can be discouraging to see only up and to the right for a couple of months, and then all of a sudden there's this dip, and you go, I'm losing all this money. And it can be helpful to kind of take a step back, look at the big picture perspective, and understand what's really going on. So I'll share my handy little whiteboard here, and we can take a look. So ETH, I'm going to use ETH as an example, only because it's an easy example. Excuse me, I've a little bit of a flu-ish thing the last few days. I'm over it, but I have a residual cough, so apologies in advance. And ETH tends to follow the general trajectory of the market as a whole, which of course is always driven still largely by the Bitcoin price action. So ETH, when I checked this morning, it was something like, I think 3,015 or somewhere thereabouts. Okay. And obviously it's been way above that. It's been way below that. That's where we're sitting at currently. But if you're someone who got into the market maybe 2, 3 months ago, and I'm just going to draw out like a hypothetical example here to illustrate what's going on. I'll leave it to you guys to kind of extrapolate out what that could mean for other assets, other situations. But let's say you bought ETH at, I don't know, 3,700. And you decided, hey, I want to use the mailbox money method. I want to create a liquidity pair. I want to take advantage of the trading fees that are being generated between ETH and other assets. And you decided that you were going to open the classic of all pairs, ETH USDC or ETH USDT. Either one, they tend to return about the same-ish APRs. And you put your money in, and let's just say again, for the sake of illustration, it was 10,000 in total. So you did about, 5,000 USDC, you did about $5,000 worth of ETH, and you decided, I'm going to play it safe. I'm going to set a really comfortable range here. And I want my range to be 3,000 to, uh, what would that be? 4,300. Let's say you just went like purely equidistant from the current market rate at that time. And so you said, oops, 4,400 math. So you said, all right, my range is 3,000 to 4,400. Now, while ETH is doing its thing, going back and forth and back and forth and back and forth, you've been collecting a trading fee income. Now, in the past, a couple months ago, trade volume market wide was up. It was like going bonkers. In fact, some people we were seeing anywhere from 100 to 150% APR on blue chip pairs like ETH and USDC. Now I think it's closer to like maybe 60, 70-ish percent. Okay. So as trade volume market wide fluctuates, so too will APRs fluctuate, which is again why we talk about, hey, if your target range is 50 to 100% APR, that's on average over time. You might have seasons of 150%. You might have seasons of 40%, 50%. That's okay. That's just part of the game. Now, where I think a lot of people get kind of caught up in did I lose money or gain money is when they see, hey, I put 10,000 in, and if ETH dropped to 3,015 from 3,700, and this was my range, well, guess what? Now my total liquidity value is not 10,000. So if ETH just stayed put, or better yet, if it went up to, let's say, 4,100, this number, my initial liquidity value, it would change with that. So the value of your liquidity pair also fluctuates with the market. So now we have multivariable equations, which if you're just looking at like a P&L or something, it can drive you nuts because you're going like, okay, but my liquidity value is fluctuating, but trade volume is also fluctuating. So my APR is fluctuating. So everything's constantly in flux. And that's why doing something like this can be confusing and or overwhelming. So what happens is people see a number like they're 10,000 in liquidity and it drops. And I don't know what the exact number would be there, but let's say it drops, $2,000 or something. And you go, oh my God, I lost money. That's the initial, the human brain goes, oh, I lost money. But you didn't realize the loss unless you pulled out all of your liquidity, removed liquidity, and converted back to stablecoin and cashed out completely and sent it back to your bank account. That's where you realize the loss. So if you bought the thing and then it dropped to this and then you completely cashed out and then sent it back to your bank account, you go, yeah, you would have realized a loss. That's how to lose this game. Okay. Obviously, I'm not recommending you do that approach. I'm just acknowledging when someone experiences that for the first time, it can be pretty jarring where you go, oh man, I'm losing constantly. Well, consider the fact that if you had not created a pair and you had just bought ETH and ETH goes down in value, you would have lost even more. And again, I don't know what that number is, but I'm just going to make up a number for the sake of illustration. It would look like an even bigger loss on paper. So part of pairing in terms of like the net function is that not only do you get trading fee income from the process, but it actually helps to mitigate your losses during retraces or downturns. Okay. Now, I'm going to add another variable here as if that wasn't already enough. So not only does it help mitigate, but remember our range up here, our made up range? If I had started with an approximately 50-50 split between ETH and USDC, because remember, the ratio of the two assets that I'm pairing together fluctuates as well. So in this example I'm giving, as I get closer to 4,400, my pair will become more USDC. If I get closer to the 3,000 mark, my pair becomes more ETH. So if, again, just a moment in time, if that moment in time I'm at 3,015, I'm probably at like a 95.5, meaning my pair is now distributed as approximately 95% ETH and only 5% USDC. So even though on paper, the displayed value of my pair will be lower, that's partially because I now have more ETH than I started with. So again, in effect, I have DCA'd, dollar cost average, into more ETH as it goes down. That's why this is a hedge against market fluctuations. So then I could say, all right, if I think ETH is coming back in the very near future, I could just sit tight and I go, you know what? It's going to recover. No big deal. Or the other option I have is to remove liquidity. And if I removed liquidity, I now have a lot more ETH than I did originally, which is a win either way. But our brains don't default to that mode, right? We think only in terms of what did I gain in dollars today? So this is a shift from thinking not just in terms of dollar value, but also thinking in terms of asset accumulation. So in my little example here, I don't know what the exact allocation would be. You know, let's say it was 1.5 ETH, and I ended up with, I don't know, 2 ETH or something like that. The point is you would end up with more. Now, the other option, well, let me pause there before I go even deeper. Any questions or thoughts just about that part of it? Cool. Crystal clear? All right. Now, here's the other possibility is I started with my range of, what did I say? 3,000 to 4,400. Market rate started at 3,700. And let's say it goes down even more. Let's say it drops below 3,000 and it goes all the way to, I don't know, 2,500. If that were to be the case, you would now have 100% of your position would be ETH and 0% of your position would be USDC. And this happens frequently. You create a pair and you go out of range, whether to one side or the other. And whenever you go out of range, the pair ratio gets converted to 100% of one asset or the other. Now, it's not a permanent state because as long as you still have the liquidity position open, it can potentially swing back, okay? So, but if my original range was 3,000 to 4,400, I'm all the way down at 2,500. Then your brain goes, oh my gosh, it has to recover so much before I start earning trading fee income again. which is where the rebalance option comes into play. But if we don't want to realize any amount of impermanent loss, there's a method where you can rebalance so that you are still just above market rate and your position will still be 100% ETH, 0% USDC, and you don't have to swap any of this ETH, which is now only worth 2,500. You don't have to swap any of it to get USDC. So the simplest way to think about this is if this was my original range, 3,000 to 4,400, and the new value of ETH is, again, just by illustration, 2,500, I could reset my range to something like 2,510, keep the original upper limit, 4,400. If I clicked on rebalance, or I removed liquidity and created a new position, either way, but if I clicked on rebalance and rebalanced to 2,510 to 4,400, now my position is still 100% ETH, 0% USDC. Why? Because I'm still out of range. So I didn't say, oh, I'm going to reset my range so that it's 2,000 to 3,000. You could do that, but usually that's not necessarily always the best move. There's a time and a place for that depending on context, but you could do that. But what I'm saying is what we anticipate for the near future, which is ETH recovering and recovering hard along with everything else in the market, then okay, if it's going to recover, I want it to get back in range as quickly as possible. And so to do that, I just reset the range to be right above where the current market rate is. So now, again, in this illustration, let's say I do that and the market immediately recovers in the next couple of days and it goes back up to 2,750 temporarily. I go, cool. Now I'm in range. I'm collecting trading fees and I'm sitting pretty. And then eventually it goes up again, 3,000 and on and on. Okay. So this illustration is for when we anticipate the general market trend to be up and to the right. Okay. And that's why I say true bear market is different because true bear market, we anticipate the opposite, like a general downward flow. That's a different strategy. When we get there, we'll talk about what to do in those situations. This is just acknowledging that our default mode for most people, our default mode is to think in terms of dollars. And when we see the dollar value dropping, our gut level reaction tends to be, oh no, what's going on? What can I do? I'm losing money. This isn't working. Because we think that for something to be working, it has to be only positive forever in terms of dollars, which it doesn't. Now, the nice thing about the mailbox money method is that while you are riding the fluctuations of the market, so I'm going to call this your base capital. While you are riding the fluctuations here, up, down, sideways, you are, of course, collecting trading fee income. That is, in my mind, not only a net positive, but it's also, if you need it to be, it's a way to balance in your own psychology the need for, oh, I have to be gaining incrementally always, which is fine. Like, I'm not saying this is a bad default mode. I'm just acknowledging it and you can acknowledge it too. And that way you go, oh, it's a bias and it's present. Once you acknowledge a bias, you've kind of already halfway defeated it. Because I don't think we'll ever like completely defeat our natural cognitive biases. But by being aware of them, at least we're aware of them and we can adjust accordingly. So my base capital is going to do its thing. while it's doing its thing, I'm making $100. I'm making 120. I'm making 110. I'm making 150. Whatever those daily numbers are for you, I don't know how much capital you have deployed, but whatever those daily numbers are for you, they're just constantly flowing in, flowing in, flowing in. And that's why I typically advocate for an approach where you say, hey, take just the trading fee income that you're earning, take that, stuff it away in a mattress, meaning like create a separate wallet address in your MetaMask or wherever, and just store what is the gains from your efforts as a liquidity provider. That way, no matter what this is doing in the short term, you have this other thing over here that is always a net positive and is always going up. Now, this could be if you like know that this is like for you, it's hard to like wrap your mind around base capital fluctuating. This could just be stablecoin if you want it to be. You could always take your trading fees and say, hey, I'm earning trading fees in ETH and USDC this month. I'm just going to convert it all to USDC and stuff it in the mattress. That's actually not a bad plan. It's not the most possible upside. It's rather a way to say, hey, here's my extra little bit that I have all the time. The other option, which is typically what I'll direct people towards, because I think it's the better long-term play, is just accumulate macro belief. Bitcoin, ETH, Guard, Sol. I don't know. Maybe you love Tron. Nothing wrong with Tron. It's a good one. Now, in those cases, it would also fluctuate. But as it fluctuates, you can kind of just rest and know, like, okay, it's fluctuating, but even if it dumps 50%, it's still a net positive because it's just what I earned over here by being a liquidity provider. All right, let's open it up. Questions, comments, thoughts, anything? Mark?
Yeah, I think
Oh, yeah,
I
go
think
ahead.
Brandon, it's pretty much having to control your emotions, your biases, your perspective. You really got to remember that the market is driven by just buyers and sellers. You either got a group of buyers that are buying, it's the price is going up. When everybody's selling, it's going down. And we've got the fear and greed index, indicator as well. So I mentioned you mentioned through this presentation, you're just talking about controlling your emotions and getting perspective.
Yeah. Yep, exactly. That's ultimately what it comes down to. And in my mind, controlling means being aware of those biases.
If I may, hello everyone. Thanks, Brandon. That was actually good. I learned something valuable today, especially with the rebalance option. I was tending to rebalance, just split it in the middle, but you obviously don't realize you're splitting the ratio between something like USDC, which is a stable coin, which actually means you're losing money if it or let's say not necessarily losing, but you're not regaining as quickly as you would if you set the parameters 100%, let's say like ETH. And I think I don't know if it's just me, but the timing of this message is really appropriate because I fell out of range with a few of those pairs of mine, and it's always like this. Obviously, what are we doing? Are we waiting it out? And because I think the scary thing in crypto is things can happen real quick, and I
Correct.
think that's the thing where you almost feel like you want to anticipate that, but that's where the strategy is so helpful. Thank you.
Yeah, you're welcome. And yes, things happen quickly in crypto, which is a blessing and a curse because it's awesome when it's going bullish and you're like, yeah, everything's going up. But then when things dip just as quickly, it can be kind of jarring. Like, what? What? It happens both ways? Mark, you look deep in thought over there.
Oh, I was just thinking how I train my body or my mind to not go crazy is when I know it's not going up, 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 I just don't pay much attention to it at all
Yeah.
because I always feel I do. I have like 30 grand and I get really excited when it gets up to about 35. And then I get kind of depressed when it drops down to 25.
Right.
So that was good advice you gave.
Something else, if no one else wants to comment, but there was this thought with me. If you want to set a bigger range, obviously, or let's say a tighter range gives you more APR, right? Because your liquidity is more focused, so you get a greater kickback on the fees. But obviously now again, if you keep the ratio in mind, your let's call it the ratio of growth is obviously lessened. So for a long time I had this idea that I want to keep like a more narrow ratio, and then just cash out when it or let's say rebalance rather when I fall out of the range on the USDC side. But thinking about what you said now, there's nothing wrong with at the bigger range. Also, if you're willing to play a bit of a more patient game, because
Exactly.
your your asset will accumulate. Obviously, um, less fees, but it will accumulate quicker if the asset grows itself.
Yeah. Yeah, and I mean the tight range, it's just a different game to play. It's not necessarily right or wrong. You just have to be willing to play that game. And I know people, I mean, there's a few people in the mastermind that are playing that game. And they'll generate 3,000 a day in trading fee income. Are they keeping 3,000 a day? No, of course not. But they're still keeping, 1,000 or more a day, because there's all these additional fees associated with rebounds constantly. So if you play it and you monitor it, you can still come out ahead like really, really well. But again, in my opinion, I think for most people, the game is just be patient, play the long game, acknowledge that. And this is another point too, like you don't have to be in range 365 days out of the year. So people fall out of range and they go, what do I do? It's like, well, the first intervention actually is just to wait and do nothing, which is hard to do, right? But it's accurate. So if you figure if I have a position and let's just say for the sake of illustration that I'm going to hold it for 365 days out of the year, you don't have to be in range 100% of the time in order for that position to be very effective and very profitable for you.
Yeah, and that at that point of what you were talking about, the guys keep changing their parameters and rebalancing. That becomes more of a day trader kind of guy, and I have a job.
Exactly. Yeah.
Yeah,
And so then it becomes personal preference. Like if
yeah,
you have 4 hours a day to sit down and monitor this stuff and you like that, and there are people who love that, and
right.
I think it's great, then by all means, do play that game because that game fits with your lifestyle, your career path, your free time, what you enjoy doing, for sure.
Just not good, bad, right, or wrong, but it wouldn't work for me.
Yes, exactly. And that's also part of the beauty of this approach is
Right.
there's multiple pathways depending on what you have capacity for and what you have space for in your life.
Brandon, I was just about to ask, like, I guess what's or maybe for you personally, what's a good thumb rule if you fall out of range to wait like a week, 2 days, kind of
Yeah,
just watch it? Or
in general, I'd say 48 hours. And then depending on, what the situation is, I might wait another day. But then I would not rebalance for sure, but I would strongly consider a rebalance. And like in this example of the ETH USDC, if it keeps dipping a little bit more, I would just do that little rebalance right up to the edge. Doesn't mean I'm in range again, but I'm close. And then if it keeps dropping for another 3 days, I go, okay, I'm just going to do the same thing again. Because all it's going to cost me is probably like $1 in, transaction fees on Crystal or something like that to widen the range a little bit more to catch up to where it's at. So that's part of the nice thing here is you can keep doing that with like minimal cost associated with it.
can I ask maybe just on that, like which network has the lowest fees that I found? Obviously, the Ethereum network, I learned to my detriment, has
Yeah, those fees are
ridiculous
crazy,
fees.
man.
So yeah, that's
I don't know
um,
who's like actually the lowest. I know that the base network and the Arbitrum network are very low when it comes to like Ethereum based networks. Um, BNB can be low. It's probably not as low as something like an Arbitrum and Base, but it does also partially depend on like network congestion and how much volume is happening on that network.
okay.
So part of the reason, for example, Base and Arbitrum, part of the reason they're so low right now is yes, the way they built it, but also because there's not as much total volume compared to the other networks flowing through them. If they get popular, which is very likely in the coming years, probably those will go up a little bit. But I don't suspect that they'll be anywhere like Ethereum during times of high trade volume. It's just bonkers. I can remember paying $700-800 per transaction for back when I was trading meme coins on the Ethereum network. So it's only worth it if you're gonna like profit 30,000-40,000 on a trade. In general, I think if you play on Arbitrum, BNB, Base, Solana, and Polygon, like those five, you'll cover a vast majority of the liquidity provider opportunities that are available right now. All right. Any other questions, thoughts?
Yeah,
Where is
Brandon.
everybody? I'm in Southern California. We're on fire.
Oh, well, Mark, this is actually this is not the mastermind call. This is a different one that I just host once a month as a volunteer
Okay,
in the Web3 Wealth Builders group.
right.
So this is not going to be the main mastermind calls.
Okay.
Those are, but funny enough, the mastermind calls are also at the same time slot on Mondays. So that was unintentionally confusing on our part.
Mark, all the best there in California, man. Yeah, just let you know I'm from South Africa, so
Are you in South Africa now?
yeah. In
Ah,
it's almost 9 o'clock, getting
wow.
ready for bed.
Wow.
Hey, I've got another question for you, Brandon. Obviously, there's it's with what's going on in crypto. where do you look for reliable information?
Ooh, yeah.
Yeah.
That's
This
uh
is
that's a tough one. I don't know that I have one singular source that I would look to. You're talking about like news outlets.
yeah.
Yeah, I mean, when it comes to news stuff, the best you can do is be aware of all of the rumors that are floating around and then monitoring how those rumors influence, not necessarily drive, but influence market trends. So, for example, there's been a lot of talk about, oh, they finally what was it? The SEC finally gave someone permission to sell all this Bitcoin that they acquired during the Silk Road, where they took all the Bitcoin from Silk Road because of all the illegal drug activity or something like that. And I go, okay, that's probably true. And also, it's probably a little bit of an attempt to manipulate the market because there's also talk of, oh, the US has suggested that they will possibly sell, I forget what it was, 2 trillion of gold and acquire 2 trillion of Bitcoin, basically like flip-flopping where a large chunk of their overall reserves are held. So flopping from gold into Bitcoin for what amounts to, even though it's trillions of dollars, what amounts to a small percentage of their total treasury holdings. So I look at those two stories and I go, hmm, they're probably both true, but also it seems more plausible that media outlets are trying to kind of manipulate the price to go lower so that the treasury could buy in at a lower price. And then my mind goes, well, to me, that's not conspiracy theory. That's more like someone's trying to always manipulate the market, like to make a profit. That's just people chasing money. Like that'll never change. Um, so I take that all that information with a grain of salt and I watch the market and then I think I would not be surprised if there's another little dip as people panic sell, thinking, they're going to sell it all and the chart's going to collapse right before there's a massive run up. So that doesn't really answer your question about where to find reliable info.
I think that was another question I have. It's almost like what's the current market, what's influencing what's happening right now. And I think what you're saying is that, yeah, it adds to that.
Yeah, you have to assume that there's always going to be a big chunk of the crypto market that includes a lot of retail investors who don't really know what they're doing. Well, I guess the stock market has that too. But the point is, there's a lot of, not a lot, I guess, but there's always going to be a good chunk of people who are in the market who don't necessarily know what's going on. And they will panic buy and FOMO, or they will panic sell and FOMO buy based only on what the media says. So you got to read that stuff and go, okay, probably the masses will react to this news, but I don't necessarily need to react. I can rather watch from the sidelines and see if it plays out the way that I think it will.
I think the obviously the trick will be to almost know how the masses will react also, but and to like be strategic about that, obviously.
It's like for a while, every 6 months, China was going to ban Bitcoin, but it was the same story and it never came to pass. So this was like years ago. It'd be like, China's going to ban Bitcoin. Oh, didn't happen. 6 months later, China's going to ban Bitcoin. Oh, didn't happen. But every time the story ran, Bitcoin would dip because everyone's like, oh no, China's going to ban it. It's all going to fall apart. It's the kind of information that people like to just create false narratives in their mind and sort of hyper exaggerate what the potential implications are.
So, Brandon, for your simulations, are you still using Crystal and PancakeSwap, or are you using anything else?
My two main go-to platforms are Crystal and Orca.
Oh, right.
And there's also one called VFAT. So V is in Victor, FAT .io,
Okay.
VFAT.io. That's a nice one. It also has a lot of great opportunity on the base network via Aerodrome. Because Aerodrome is, I think, just to use it directly is still pretty clunky. And there's some other spots where you can leverage the base. Well, even on Crystal, you can leverage the base network. But VFAT tends to be paying some better APRs on the same pairs than Crystal presents.
Yeah, I came across another one the other day, Metric Finance. They have a really nice user interface
Yeah,
for the
that's
credit
what's his
carriers.
name, Jake Call or whatever that guy's name.
That's right. Yeah.
Yeah, yeah.
Mm,
Yeah, he's a savvy dude because he has his YouTube channel and then he also has like some kind of mastermind thingy. I'm not sure on the details. And he's building a software, he's building a
yeah,
platform
he is.
on
Yeah.
which to trade. And I look at that, I'm like, that's actually really smart because even if someone doesn't buy his main thing, they can trade on his platform because of his YouTube channel, and he still makes money off of it.
Yeah.
I was toying with the idea of starting a thing like Crystal at one point, and then I was just like, oh man, I don't know. It would cost so much money to develop
Yeah.
that. And then you have to get users to it. So that's a whole other game.
Yep. Got to keep life simple, right?
Yeah. But the metric, is that what it's called? I forget
Yeah,
what.
Metric. Yeah,
Yeah,
Metrics,
metric.
Metrix.
The this was a few months ago when I looked at it. It looked like it was pretty much the same opportunities as
Mm.
Crystal, unless they've upgraded it since then.
Yeah, exactly the same opportunities. It's just that had when you're setting your range, it had it in landscape, and you could actually see the graph, the market graph,
Oh, cool.
and just set your range. So there are just a few extra features on there that just made it more visually, um, you know, that you could actually see it, rather than just a small little narrow range, say on Pancake Swap. It just created just a bit of visual so I could understand it better.
Nice. Yeah, and oftentimes that's the difference, right? Is the user interface, even if
Mm,
same information and same opportunity, if the user interface is nicer and easier to use,
mm.
difference.
No, very cool going forward.
Yeah. All right. Well, if there's nothing else for today, we've only got a couple minutes left anyway. I'll close the session up unless anybody else has like final thoughts or questions today.
Perfect timing. I got to get to work.
All right. Sounds
Thanks, guys.
good. Awesome. All right. With that, then I'll let you guys all go. Thanks for joining us today. And in the Web3 Wealth Builders group, just keep an eye on not only the main wall and the posts, but also that classroom and calendar tab up at the top. Those will be kind of the two main resources for that group. So, all right. Thanks, everyone. Have a great day, and I'll see you again soon.
Cheers. Thanks, guys.